From the morning reading, the Qs and SPY bounce on day 7 of a bull flag pullback. Ulta reverses, closes higher after earnings per share. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:44 a.m. Mountain Time, and I'm recording this in preparation for the market day, March the 13th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Well, let's go ahead and dive into the morning report. And at the time of this cut, we are rotating around scratch in all four of the U.S. broad-based indices. Crude oil was down about 0.25%, euros down below scratch. Long bonds are rotating just above scratch, and gold is up about 0.25%. In overseas action, you have China up about 0.75%, Hong Kong up over 1%, Japan up just above scratch, Germany up just above scratch, and the United Kingdom up about 0.25%. And macroeconomic reports for today of note for the United States, there are none. And looking forward to tomorrow, we have PPI, and that looks to be about it. So pretty thin at the beginning of this week. We do have some important Fed later this week, but Monday and Tuesday looks to be pretty thin. In terms of current volatility conditions, short-term VIX 10.67. Skew is still elevated and almost to a 140, so that's definitely in warning category. IV percentiles are exceptionally low. The S&P a 2, the Russell a 0, the Nasdaq a 0, and the Dow a 12. In terms of standard deviation size moves, frankly, almost all of last week was devoid of standard deviation size moves on a close-to-close basis, and we've had nothing in the last 4 closing sessions. In terms of, let's go ahead and go to the charts. The S&P chart, you see we've been in this, as one of the morning authors mentioned, a multiple day bull flag pattern. Really nothing here to challenge that bull flag as of yet. This seems to be a classic continuation pattern with an expectation that we're going to break to the upside at some point. On the Dow, same thing, multiple day bull flag pattern. And really you could draw a line across all this and start to take a look for this to break. And then the Nasdaq, you'd be looking for a horizontal breakout. Look for action up above the round number of 5,400. And then the Russell. Russell's been going much weaker than the other 3 indices. While they look to be in bull flag patterns, the Russell looks to be in this continuation of a sideways pattern, and is started to dip down into a thin cloud and really fall into an outright neutral intermediate term market posture. Let's kind of keep that in mind. We need something more than just a diagonal breakout to be meaningful here on the Russell. In other markets, crude oil has been in a major breakdown, and ever since we earlier in the week on this big candle here went just about all the way across the cloud, clearly broke both the lesser important diagonal support and more important horizontal support, fell clear, it confirmed below that, continued that breakdown, and now we are on a cloud breakout to the bearish side. So everything about crude oil is bearish, and any longs here are very, very counter trend until you find something of a reversal pattern. But we've not even seen on the daily basis any kind of signs that this is about to even bounce for a short-term bullish move up. In terms of gold, gold also has been breaking down from last week, though did have a bit of a reversal pattern come in for at least a short-term support on Thursday, or I guess that was Friday, and then this is today's candle thus far, which is not very strong by any means. So crude oil and gold and bonds also breaking down. We've been talking about the expectation that bonds would likely break down to new lows, and that certainly came true at the end of last week. So when you take a look at all of those, well, why is that happening? Well, a big part of it is the dollar, and I'm not sure why some of these symbols aren't working of late, but I don't know how else to get around to the dollar. Here's euro dollar, and you see that has been moving up. So certainly big move on the dollar of late, and that is having an impact on these other markets. Okay, let's go ahead and take a look at the VIX, and the VIX continues to be exceptionally low volatility. It's in a daily squeeze and been hovering around plus or minus the 12 threshold, which has been important to us because we look at the 12 threshold as anything below a 12 threshold is extremely low volatility. And then the normal bull market trading range to be 12 to 15. So this is playing around very low levels of volatility. There's no significant fear being priced into this market. And as such, large moves in the indices, either up or down, are generally not expected from a probability standpoint, with a VIX hanging around a 12. And let's go ahead and go to the daily report. And we continue to be relatively bullish over here, and we should be, though we start to see some signs of warning and other deteriorations, and we'll take note of those as we work through this. First of all, market trend intermediate term phase opinion. We have had that break of diagonal support on the S&P that has given us a market phase 5. It has not yet broken the horizontal support, so this is kind of a weak early warning. The other thing is I would consider this still weak at this point because we've seen an oscillation in recent weeks where we would at times break into market phase 5 and then back up to a 4 or some other bullish phase and then oscillate back down to 5. So we've had this kind of sideways consolidation action, which has caused this particular indicator to kind of flip back and forth, but neither flip to the downside, bearish side, or to the bullish side, achieving anything of note. In terms of the 3 market timing signals, these are, again, relatively consistent to the bullish side, but some warning signs coming in. In terms of the 3, the first one is IBD, giving us the confirmed uptrend that is bullish. The second one, the GMI index, a 5 out of 6, the buy signal in place since 11:10. That one is bullish. The stock charts decision point scoreboard, this is on the intermediate term, which is our primary signal for a buying signal, is bullish, but we've had some warnings come in with mixed signals coming in on the S&P 500, the Nasdaq, and the Dow at this point. So while we were just one arrow away from a perfect stack that we so long looked for, we've had some recent deterioration that has caused these short-term bearish signals. So kind of keep that in mind. Overall consensus here is still bullish, with the expectation that either down legs or up legs are going to be relatively short in length given these kinds of mixed signals. Position sizing opinions, both models still coming in at 100%. Intermediate term market posture has fallen into a weak bear on our primary index, the S&P. It's been in a weaker situation on the Russell already. That was the kind of tell leading down. It was the first to break down and has gone from weak bear to strong bear at this point. The Dow and the Nasdaq are still holding on to exceptionally strong bull intermediate term market postures, but just barely. If they fall below an 80, they will both go into weak bear as well. Also of note is that the falling sentiment line is in place. So with that falling sentiment line, we would not quite have the same strong long-term support that we would expect when we've had a more bullish sentiment line as we have most of the time of late. So some deterioration here as well. Overall strength of the trend, while this in absolute terms has started to fall a little bit, it's still a very, very high area. So overall strength of the trend is still considered to be in the bullish camp. Hedge warning status, we still remain 0 plus normal with some elevated conditions. In terms of the three strategy opinions, so again, this note that we've had pretty commonly here of the last couple 3 weeks is that the VIX is right at the acceptable threshold to initiate new positions for novice traders. And as long as we're playing with the VIX around 12 or below, that's going to be in place. Still relatively conservative on covered calls. It's very difficult at these kinds of patterns to be piling into lots of new bullish positions, given that we've been in such a sideways consolidation and there's very little follow through. If you're going to make money on covered calls right now, frankly, for most setups, it's going to be that you're going to make the money off of the selling of the premium of the out of the money and in the money strikes. And you'll probably make more off of that premium than you will off of any capital appreciation of the underlying stock. So just kind of keep that in mind as you set those up. In terms of put selling, any kind of weakness that you get on individual charts against a portfolio background expectation of generally bullish would be expected to be an opportunity. Just kind of keep an eye and see if we see any of these warnings start to build in terms of their both change and rate of change. Now, in the specific areas of warning, we really aren't seeing that much down here, and that's part of the reason why I am not yet getting too concerned about this weakness. Now, obviously, this week we do have some big news coming. Later this week, an expectation of an interest rate increase. And you know, while well telegraphed and expected, you just never know what the market will do when they get those announcements. And of course, the announcement's kind of a binary decision, but it's also a future expectation, because along with that announcement will also likely be some language that'll steer the market in terms of when the next interest rate increase would be. So it's not just about this interest rate, it's about when the next one might be and what size that one might be. We've gotten used to these little 0.25% increases, but the Fed's not limited to that. It's always possible they could do something more, though that would be not very probable. But the market certainly will be looking to see what the tea leaves are in the communication and what those future expectations are. In terms of these areas of specific warning, though, under the volatility area, there really is very little, just this persistent elevated skew. And certainly, given the profits that have accrued, some 10% since the post-election period started, there are many people who are probably doing some put protection, and that's probably part of what you're seeing with these elevated skews that we've had running for day after day of late. In terms of the trend-based area, this is more concerning. We've got market phase 5, we've got weak bear, and we've had several days in a row with the New York Stock Exchange new high, new low indicator coming in with well over 300 on the new low. So this is a more concerning area of warning. In terms of the key intermarket risk aversion indicators, we've got currently 2 is risk off, 3 is risk on. This is relatively neutral overall at this point. Some of these have been kind of wrapped around each other and flip-flopping back and forth, so kind of keep that in mind. We certainly are not getting any kind of clear signal at this point of risk on versus risk off from this set of indicators. Sentiment Nothing particularly exciting here at this point. The Fear and Greed Index is at a 66, so a little bit elevated on the greed side, but certainly nothing extreme. In terms of sector-specific performance on Friday, you see the overall market was up slightly, but look who did the best. Well, it was a defensive day. Utilities, telecom, consumer staples, three of your top four performers for the day, and very, very good breadth on each of those defensive sectors. And whereas on the flip side, some of the more risk-on financials, energy, consumer discretionary, materials, had performances that were less so. Now, certainly healthcare, materials, and consumer discretionary were positive and did have decent breadth, but certainly the primary performance on Friday was a risk-off, more defensive-oriented kind of performance. In terms of looking at market posture by the various different time frames, we could see that transportation, telecom, energy, materials, and retail, and I believe everything I mentioned there except for telecom is a risk-on sector. These are generally the weaker sectors across these different time frames in terms of their market posture, so that should also be somewhat telling to you. And you see the 5-day performance last week, a relatively weak performance. Not much here to get too excited about. Information technology perhaps being the most consistent, and that bears mentioning in that look at the 3-month, 10.24. One of the best performances, the 1 month, one of the better performances, and then of course one of the better performances on the last short-term time frames. In terms of relative rotation graph, some of the ones that are up and coming, ITB, XBI, FDN, so home construction, D.R. Horton and others are doing exceptionally well, so you might want to take a closer look into that area. We've seen some improvement on healthcare of late, and that seems to be in part led by the biotech. Biotech can be quite volatile, but that might be also something to take a look for some of your more aggressive stuff. And then FDN, who was the hero for a very, very long time, very strong and consistent performer for quite a few months. It rotated down and now has started to rotate back up into the upper right-hand quadrant. So coming back into favor, one of our previous favorites, FDN. So kind of keep that in mind. Others of some note, utilities and real estate tailed off a little bit last week, but still in this upper left quadrant and have been, certainly for the most part in recent weeks also improving. So those would probably be the 5 best sectors to take a look at, or sectors or industry groups to take a look at this point. So when you put all this together, we might be seeing some positives in the ultra short or short-term indicators, but some new sell signals have been coming into place, and certainly with some of the intermediate term indicators starting to look for a bit more bearishness, we might be in for a bit more of weakness. At this point, that weakness wouldn't be expected to be terribly pronounced. Might even be buying opportunities, but we'll certainly be watching for change and rate of change to see if this should develop into something more aggressive to the downside. But certainly to say that we're in a healthy bull market where you can almost do nothing wrong in terms of what you buy, we're not there yet. So kind of keep everything in mind, keep everything in your risk management in the front of your mind at all times. So this market is showing some signs of weakness at the very least, and we'll have to see just where this goes. The Fed announcement this week could be a key input for the performance of this week, either to the upside or to the downside. Okay, I think that's probably enough for today. Let's go ahead and wrap this thing up. I'm going to roll through a number of slides here. If you see something of interest, just hit the pause button. And we'll get over to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom of the slide that would take you to the full set of disclosures. Manage that risk profile each and every day, not just when the market's showing some signs of weakness, and that will give you more consistent results and certainly good trading each and every day.